Day. Today we'd like to continue our discussion of bonds. We might take a break from bonds and do a couple of non-investment topics and then pick up our investment topics later on. In the continuing discussion of bonds, we would like to discuss bonds as a funding instrument and who are the natural bond borrowers, or otherwise called bond issuers. Now keep in mind that bonds and bond-like instruments are present all over the place in everyday life. Consider bank CDs, and most of us have invested some money in at some point. Those are often quoted with an interest rate and a fixed time to when you get your money back plus the interest. Most CDs only pay interest on the CD redemption date. In essence, such CDs are merely zero coupon bonds, which means that the interest is paid back one time only on the redemption date of the CD when you get your principal back, plus this interest accrued at the rate agreed upon. So there's no coupons during the time that the CD exists, except at the very end. So when you are buying a CD, in reality, you are lending your money to the bank, who takes your money to do whatever banks do, like, for example, lending money to people to buy homes, cars, and other things. So your CD purchase is a source of funding for a bank to operate. In fact, money that we savers deposit with banks is a huge source of funding for a bank. Another common issuer of bonds are sovereign nations. Consider our own U.S. government, which is the biggest issuer of bonds in the world. Sometimes these bonds are called treasury bonds or U.S. government treasury bonds. The U.S. government, in the course of running itself, needs financing to do all the things that it does. Now, taxes are levied to assist the government in its funding needs. However, the money raised by taxes is often not available when the government needs the money to operate. So it borrows money via the bond market to address short and long-term borrowing needs, funding needs. It is, of course, hoped that the tax revenues that it eventually collects will be enough to cover the liabilities of this funding program. But if it isn't, that's where the problems occur. See Greece, Cyprus, the rest of Europe, and now even the United States government with potential over-borrowing problems. We will discuss treasuries in more detail later on. In any case, corporations also prominently raise money via the corporate bond market. If you recall in our earlier investment topics, we discussed how corporations raise capital funding by issuing stocks. Another way for corporations to raise money is by borrowing capital, and the corporate bond market is one big way that this is accomplished. We are going to discuss the difference between stocks and bonds in our next topic. There are many variations and types of corporate bonds. There are short-term instruments called commercial paper or commercial credit, which can be as short as one night, overnight, or maybe even a week or a month. There are bonds much longer, bonds, 5-year bonds, 10-year bonds, 30-year bonds, infinitely long bonds, perpetuities they call it, or 100-year bonds. There are floating rate bonds, which are bonds that have a coupon rate that can vary as a function of some changing market rate. And that's a big difference because before we talked about bonds being fixed income, meaning fixed cash flows, but here we have a variation called a floating rate where the coupon actually can adjust. We also have bonds where the payment of principal or the face amount can occur earlier than the redemption date. Such bonds like callable bonds, puttable bonds, sinking fund bonds, and we'll discuss those in time. Since a corporation can borrow multiple times in the market, if the market is willing to lend that issuer, one issuer might then have many different bond issues of various maturities, coupon rates, and other features. Take Ford as an example, has thousands of such different bonds. The municipal market, representing cities, counties, and states, can operate in the same way as corporations. Sometimes the bond cash flows are tied to municipal projects like water, electricity, nuclear power, etc. Municipal bonds are often guaranteed by revenues from these sources and sometimes taxes as well. In addition, both corporate bonds and municipal bonds are rated by agencies whose principal job is to evaluate the credit worthiness of the borrower, the issuer, and there's a whole rating system set up that is based on these valuations and the opinions of such rating agencies like S&P, Moody's, and Fitch. Such agencies will aid a potential lender in making a decision whether to participate in a new lending program by the corporate or municipal issuer. We will discuss such valuation techniques in time. All this is coming. The corporate market is vast and complicated. Another big class of borrowers are homeowners who often cannot fully pay for the purchase of a home and thus will enter into a contract, usually with a bank or a finance company, to finance their home after making a required down payment. Such a contract is often called a mortgage, another topic for another time. Banks will often take that money that we as savers have, loan it to the homeowner, the mortgage purchaser, and lend it at a higher rate than they pay us, the savers, the ones who have savings accounts and CDs. Thus, the bank earns the spread between borrowing and lending. What they lend at is at a higher rate than what they're able to borrow at. So that's how banks function. The homes themselves serve as collateral for these loans in the unfortunate case when the borrower cannot pay back the mortgage loan. In fact, there are other types of bonds backed by tangible assets, like credit cards, auto receivables, and other things that are commonly referred to as asset-backed securities. So don't think of the market as just including homes and mortgages. There are other similar kinds of lending devices. So more on all these topics later on. Thank you very much for your time and have a good day. Take care.